Welcome to the Market Beat Podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. There are a lot of ways to make money in the market. Value investing, growth investing, long-term investing, swing trading, day trading, pattern trading. You can use indicators like moving averages, Fibonacci retracements, patterns like a cup with handle, double bottom, MACD, relative strength. I mean, the list is really endless. But sometimes you can hurt your trading or investing results by mixing and matching different approaches. That was something I actually learned very early on in my trading career. Find a methodology and stick with it. Personally, I like a combination of fundamentals and basic technical chart indicators like moving averages to identify potential buy candidates. And then I overlay some human judgment when it comes to the timing for either buying or selling. But going strictly by the technical signals can also be a very effective way to trade. And that's what we focus on in today's interview. Phil Newton is a trader I've gotten to know over the past year or so, and he's very focused on systematizing and automating his trades so he can enjoy other aspects of his life. And he talks about that in this interview. And I have to say, I agree with Phil's approach because the point of your investing and trading is to materially improve your financial position. There is or should be a reason you're doing this, not just to randomly beat the market or fiddle around with trading. So I want you to listen closely to today's interview with Phil. He goes into great detail about his process for using moving averages to pick stocks, and he shares some really actionable ways you can begin using elements of his process immediately. And Phil also offers the Market Beat podcast listeners some of his charts so you can see for yourself what his setups look like. He'll give you that URL at the end of the interview. So give a listen to today's interview with trader Phil Newton of Antivestor and Production Line Trading. All right, Phil. So right now we are seeing the broader market in a correction. And I know what you do is you look at stocks and you're a stock trader. So what are you seeing right now in the current market conditions?
Well, it's funny you say that. I actually started out as an index trader, so I do follow the indexes. So I think the first thing to keep in mind is I'm completely agnostic to what's going on outside of my window. I was resistant for many years to actually consider economics and the fundamentals and stuff and just acknowledge I'm a pure technician. And I can say that confidently these days because my time horizon for trade opportunities is about 30 to 45 days. So with that in mind, that's going to influence the way that I describe things. So I generally don't care about what's going on in the economy, the Fed, announcements, all the, again, we'll just generically call it stuff that's going on in the real world. But I'm just not paying any attention to it. And I never have done. The only times where I pay attention, actually, there's no time to pay attention to it. The exception to the rule is if I do look at a trade and earnings is tomorrow, a little bit of common sense is I'm probably not placing the trade. However, to come back to your question, price is in a retracement and a corrective move, for want of a better description. The way that I view the charts now is I'm looking for levels on the chart and I'm trying not to be discretionary with those levels. So I'm just sharing my chart with you on it so you can see what I'm looking at. If anyone's listening, we'll let you know where to get the visuals for this. But I've got 3 lines on my chart. One of them is the 50-period moving average, the 200-period moving average, and the 20. And there's nothing magical about these lines. It just allows me a frame of reference to evaluate what we're looking at. We could be using any tool or any indicator. It just gives anyone a frame of reference to look at. I'm sure our loving listeners can appreciate that. So what I want to see is price to go back above the 200 because it's right now on the S&P futures below that, and then to go back above the 50-period moving average, which it's right next to for the moment. So I'm not really worried about the crosses in the average prices in the traditional way. I just want to see price in a bullish posture, for want of a better description. So that's what I'm looking for. So I'm aiming for 4,500. And for most of this year on the index futures, which I do trade, I've been sat in cash because everything was, well, the first sign was price dipped below the 50-period moving average. So I want to see price above all the moving averages, stacked essentially. And that's going to be an opportunity for me to get positioned on the markets. And that is at its most basic what I'm looking at.
Let me ask you this. So we are looking at the moving averages here on the chart you've got in front of us. You're looking at individual stocks to make these moves, not necessarily the broad indexes.
I'll place a trade on anything that is worth it. So what you've just seen me put on the visual is if it's kind of like the back test of that evaluation. So when price is above the 200 period, the 50 period, and the 20 period moving average, when it's above all three stacked moving averages, I'm going to be taking bullish positions. And if I just did that and then go to cash when price comes back below the 50 or between the 50 and the 200 period moving averages, when it does that, I'm either going to be stopped out or I'm going to go to cash and close for a small profit. If I just do that, and I did that over the last 20 years, I've got some sort of positive expectancy. So I'm showing you the charts for this as we're doing this. I appreciate it's not the best medium for visuals, but nonetheless, you can see it and ask me a sensible question if you want. So if I just do that, then I've got an expectation that on average, over a long period of occurrences, I should be able to make some money. So that's what I'm doing. And that's how I evaluate the charts these days. Again, we could be looking at the S&P. We could be looking at individual stocks. The principle and the process is exactly the same with whatever I'm looking at. A typical example for me when I'm asked about the market and what I think, I'm trying not to have opinions on the markets. And my most recent realization that I need to stop opinions is post the market crash in 2020. I made a lot of money on the way down. And then, like most people, you get a little bit cocky, a little bit confident, and you go, stop banging your chest and go, I'm going to trade my opinion this time. And I thought there was going to be a retest of the lows, like many people in the media and the public. And I just got entrenched in my own opinion. So I backed myself into a corner and I went lots of bearish positions. The way that I do it is using stock options, and I was buying puts essentially as an alternative to shorting stock. And I backed myself into a corner, and it was an expensive lesson or an expensive reminder, but it just influences the way that the next phase of your journey. And it's been about 10 years since I've had such a huge, let's face it, cock up, listening to my ego instead of the data. And this is influencing the way that I'm answering your questions. I'm trying not to have an opinion. The data tells me I don't need an opinion. Now, I'm not saying that a system or mechanical approach is the best way to trade, but I want to sleep at night. I don't want to stress, have anxiety. I've got Crohn's disease, so I'm very sensitive to those things. I also want to spend a lot of time away from the computer. I want to do this in as little time as possible. So this is influencing the way that I trade. So stocks that I'm looking at, for example, right now, are LNG. Lima November Golf is the ticker. This is Cheshire Energy. And the energy sector is in the news headlines at the moment. But I've been trading this for several years, not because of the current events, current affairs. The way that I view things that are going on in the news and the media, it's going to speed up what is already happening. So if there's a bullish movement on a stock, for example, or an instrument like an index or an ETF, then it's going to speed up what was already happening on that instrument. And that's kind of where I'm at in my own journey, and I've, 28 years later, I'm trying to make it as easy as possible for myself.
You're right. No, I get that. Let me ask you a question here. So how do you screen to find a stock like LNG? Is it purely a moving average screen that you're working with?
What I'll do is I'll back up. So the first step to making all this work is I need a strategy that I wholeheartedly believe in. So based on that very basic explanation, if price is above all the moving averages, go long. If it's below all the moving averages, go short. So it's a two-sided approach. The second part to that is to find a small universe of stocks that behave favorably for the way that I want to trade. So the only time-consuming part of what I do is about once a year or once every 18 months, I'll go through and screen for stocks that have liquidity, that have options, because I know I'm going to trade options. And the basic premise there is that at least if they've got 1 million shares traded on average and they've got weekly options and there's volume on the options, there's liquidity there, then that's going to bring that list down to around about 2,000 stocks. I also, at a personal level, like to trade stocks that are above $20. So that then trims that universe down. Now, the time-consuming part is I'm going to take the algorithm that I'm showing you now, and I'm going to go through the stocks and find out which ones are behaving favorably. Now, I don't know which trade's going to work. What I do know is if there's a stock that behaves over a multi-decade time horizon, then there's a good chance it'll continue to behave favorably for the next 30 to 45 days. That's the logic.
Okay.
It's not perfect, but it helps me sleep at night. A good example might be if we go to Pepsi Cola, and you can see this, so maybe you can ask a question if it's relevant. So Pepsi, we all know it's a good company. It's a good stock, but it's just not a favorable stock for my style of swing trading, which is very passive but profitable at the same time. It means that I can spend lots of time away from the computer and I can check in 2 or 3 times a week. But to trade this, it's not impossible to trade Pepsi, but the data suggests that it doesn't behave favorably. So if I was going to trade it, I need to bring other things to the table. I need to bring maybe discretion, maybe patterns, maybe things that are subjective in nature to make that strategy work. And I'm trying to move away from that in my trading career. So it's not that swing trading wouldn't work on Pepsi. It's just I've got to be cherry picking. I've got to be selective with my opportunity and the timing. And I don't want to do that.
Well, I mean, let's look at Pepsi for a minute because it does meet some of the criteria, right? I mean, it's a mega cap. You've got the liquidity, you've got the options, you've got a multi-year trading history. So what's the issue on this one?
So when I plug those base rules, it's above the prices, above the 200, it's above the 50, it's above the 20. And when it dips back in between the averages, that's what I would call a buyable dip. And then when it resumes and goes back above, then I'm going to get positions on a trade. So if I just do that at its most basic, very back of the envelope interpretation, I plug those rules into the algorithm and back test it with the money management that I like to use. It's not favorable for the way that I want to trade. It's not impossible to make it work. I could use a faster combination of move and averages, but the trade-off for me then is I've got to spend more time at the computer. I've got to be a little bit more hands-on with the trade. So it's not that swing trading doesn't work on Pepsi. It's just the way that I want to trade, which is to have minimal time, minimal inputs. I want to put the trade on. I want to be passive in that regards, but I want to have the fruits of active trading at the same time. I'm trying to find that fusion of the two things so that I can be up a mountain, I can go partying, I can go and enjoy myself because I want a life. I don't want to be sat in front of the computer. So it's trying to find that fusion of both things that makes it work for me. So come back to your question. We will get an answer, don't worry. So if I apply a strategy and I'm going to filter it through the liquid stocks, and then I'm going to apply the strategy to those liquid stocks. So I end up with about 700 stocks that could be traded. And then when I put it through the algo, I should end up with about 100. I'm going to pick the best 100 stocks that have a steady equity curve. Let's go back to the S&P 500 continuous futures, just so you can see the illustration. So I can back test the algorithm, the rules, the concept, the way that I want to trade and say, if I just did that over the last 20 years, what would have been the outcome? I'm not necessarily looking at the dollar amounts. All I'm looking at, is there a steady equity curve? Yes, there is. Meaning that it's going to behave favorably for the way that I want to trade. So I'm less focused on the individual data points and the metrics and all the other stuff that comes along with such backtesting reports. I just want to know, would this have been a problem for me to trade? Would I have had to put any extra screen time in to make it a profitable strategy? Or can I place the trade and be actively engaged in the market, but without having to watch every up and down tick of the market? So when I do that, I get 89 stocks. So the last part of any strategy is consistency, not just consistency with the application of a strategy, but I need the consistency of the application on individual stocks. So I want to try and emulate the performance that I'm showing you on the algo on a small group of stocks that makes sense to consistently trade them every day, every week, every month for the next 12 months. When I reevaluate the universe of stocks I'm trading. So I've got a small number of stocks that I like to trade. I'm trying to trade them consistently so I can emulate the back-tested expectation so that I've got this positive expectancy strategy. So that's the way that I trade. So I'm not looking at every stock every day all of the time. I'm not bouncing around. I'm not hunting for opportunities. I sometimes compare this to farming. I've got a small basket of stocks that I know behave favorably for the way that I want to trade. And I'm just waiting for the setup. I'm waiting for that seed to grow and bloom into, maybe it'll produce a monetary loss. Maybe it'll produce a monetary gain. But all I know is that the data is saying that on average, I should have a positive expectation. There should be a profit. And obviously, I don't know what's going to happen anymore the next person, but I've been doing this 28 years. It must be working at some level.
Right. And I get you that it's sort of, you get the statistical expectations here, the probabilities. I think any trader should understand that. As a trader or investor, you need timely information to help you make better decisions, and analyst upgrades and downgrades can give you the outlook for the stocks you're watching, coming from the big institutions who are behind 75 to 80% of market movements. For absolutely no cost, MarketBeat will send analyst recommendations right to your inbox daily. You will get a concise summary of analyst upgrades, downgrades, and new coverage, along with relevant news and information for the stocks on your watch list, real-time portfolio monitoring tools, a rundown of the top headlines each day, market calendars, the MarketBeat mobile app, and other research tools. Don't miss out on this. Sign up right now. It's 100% free. You'll find this at marketbeat.com/ratings/newsletter. That's marketbeat.com/ratings/newsletter, and that link will be in the show notes. Phil, so you showed us an example of one that would not fit this strategy. How about a couple that do right now?
Sure. Energy sector generally, just broadly speaking, over a multi-decade approach, most things in the energy sector seem to be very favorable for this. I can't quite figure out why, if I'm going to be honest. That is on my research to-do list. But stocks that I like that are exceptional within that going to be Halliburton, PXD, which is Pioneer. We've got LNG for Cheshire Energy. They're three stocks that I really like at the moment in the sector. They all historically perform very, very well. Apple is the darling of Wall Street, as you know.
Oh, it has been for years. Yeah.
It's the darling of my strategy. I mean, if you look at it's almost straight line. It's like you can't believe the historical performance. And with the benefits of hindsight, you go, of course you would have traded Apple, but we didn't know that it was going to be such an amazing performer.
Can you walk us through the chart and just show us a couple things on Apple that you do like about this right now and how it's behaved?
Yeah, well, if we look at, say, the actual charts, when I'm visually assessing the charts, because I don't always start off looking at the charts, but now that I am looking at it, the first thing that we always want to consider is the trend. The trend is the friend. It's a cliche for a reason. If you think about it as in context, it's a river of money. And all I'm trying to do is jump on the shirt tails of the money. And that could be the institutional money. I'm just trying to catch a piece of what they're doing. So generally, whenever I'm looking at a chart, I look at the last 12 months, at least 12 to 15 months, and just trying to evaluate. If the chart starts at the bottom left, it finishes at the top right, it's got to be an uptrend. Now, I've got a mechanical evaluation, as I was just showing you, but if you're doing this visually, then you're confirming there is a trend. Just because the average prices are crossed upwards, for example, a golden cross, to quote the textbooks, it doesn't make it an automatic bullish trend. It doesn't make it an automatic buy signal, if there is such a thing, which I don't believe there is.
Yeah, because a lot of people use that as an indicator, don't they, as a buy signal?
Yeah.
Okay, so you're saying that is not necessarily. Why is that?
Well, the indicators by nature, they're always lagging, aren't they? So all I'm trying to do is use the moving averages as a framework to evaluate price. So I'm not married to the crossover points in the traditional sense. Again, all I want to do is say, where is price in relation to the three moving averages? That's all I'm looking for. But when I do look at a chart, I want to then visually confirm. As I showed you just a moment ago, it's not critical to the process, but there's just some things that can't be quantified. And again, just a visual common sense approach. Start at the bottom left, finish at the top right. I was expecting to see a trend. I am seeing a trend. Great. I can move on to the next part. And this is where I'll then just zoom in a little bit more so I can see the detail. So if we look at where price is right now, so where is the latest data point? Yesterday's close, essentially, or right now's open, depends on when you're looking at your opportunities. And all I'm doing is saying, where is price in relation to the moving averages? It's above the 200 period. It's right next to the 20, and it's below the 50. Now, I want the 20 periods below the 50, so we've got a slightly longer and deeper retracement as we're doing this. And just to date it, it's the middle of March, if you want to. Depends on when you're listening to this. So what I'm looking for is I'm waiting for price to be above all three moving averages. I'm not necessarily worried about the crossovers and the fact that one's here and crossed over there, and it's of no consequence. When price is above all three moving averages, I will be bullish. And I want you to pay attention to the way that I said that, Kate, because I'm trying to make a statement, and that makes it an algorithm. And then there's no ambiguity whether, you're looking at the chart in one way and trying to read the patterns. It's like both of us can agree that when price is above all three moving averages, it is above all three moving averages. There's no question. Because we're both looking at that same frame of reference. And that means that I can replicate it.
Let me confirm this for the listener. I'm looking at these charts right now that you're showing me, Phil, and I'm looking at all the spots here where the price did move above all three moving averages. And you're absolutely right. In every instance, there was an uptrend. Now, a couple times it pulled back a little bit before before resuming the uptrend. But on every single occasion you're pointing out where it did cross above those three lines, boom, you did have an uptrend in the stock right there.
And you raise an interesting point. It doesn't mean it's perfect. I still lose money from time to time, but it's from time to time. I'm looking to, like any business, to make money on average over a long period of time. There's going to be periods of time where it doesn't work, But one of the ways that I can combat that is by not having stop loss. So the way that I get around, don't panic, instead of trading with stock, I use a stock option. I'm going to buy a lot of time, more time than I'll ever need. Again, I'm looking for 30 to 45 days as my time horizon. So I'll buy, 120, 150 days, maybe longer. So it's plenty of time. So I'll still be impacted by all the concerns that go along with options, but they're going to be minimized initially. So that if I have to wait for my trade to turn around, then I've got the luxury of a little bit of extra time on the clock. It also means that I've got a timeout. If it's not working, I can let it expire in 120 days. So I also use the full price of the premium as a built-in stop loss. So I don't have to have a stop loss, because the mistake that most people make is they're over positioned. I want to trade small. I want to trade frequently. I don't know which ones are going to work. So I've got to take every trade without deviation, without hesitation, so that I've got that consistency. So what we've got marked off, I'm actually in a long trade at the end of January, beginning of February is when I got in. And you'll notice that the algo said I've been stopped out. So that was a monetary loss. But just by simply moving from stock to an option with plenty of time on the clock means that I get the opportunity to manage it more effectively. I don't know if I'll make money on this. Right now I'm underwater on it, but I don't need to use a stop loss. It'll time out when it's not.
And you've given yourself the time for this thing to correct and bounce back. Yeah, I see this very clearly on here. Phil, let me ask you something, because I'm super curious about this strategy, because as you know, there are many trading strategies out there that kind of do rely upon a stop, or perhaps sell when you're 7 to 8% below your buy point, which is the one I learned. That's a very famous strategy, and that's the one that I came in there, introduced to this business learning.
I started there as well. We all did.
Okay, I think a lot of us did, yeah.
You know what annoyed me more? Being stopped out.
Yeah.
What they don't tell you with that rule is re-entry. That's what they forget to tell you, and that because you get stopped out, but often by a tick, and then you watch your trade idea do the thing that you expected it to do in the first place. So the textbooks never tell you to, or you can re-enter the position if your conditions set up again. And I found that helped when I was using stop loss and trading a more traditional approach. But with the options side, I get this luxury of time, a freedom of flexibility. I'm also, just to kind of finish the thought from earlier before you ask your next question, I'm using the full price of the premium as a stop loss, built in as the risk management. So I don't have to use that traditional stop loss even with the option. I get to take it all the way to expiration if I need to. Like with Apple, Apple's underperforming for me. I'm very open about what I'm trading, what's working and what's not working. This is not working for me right now, but I've got until expiration to see if I can manage it more effectively. In this case, if I can get a break-even trade because time's marching on for me, if this can turn around to break even, I'll be super happy. But just by moving from stock to an option as an alternative with plenty of time on the clock, I've got that luxury of time. The other thing that makes it work, again, just the last part of this, the secret that makes it work, it's a portfolio approach. I don't know which stocks are going to set up and when they're going to set up. I know that about 50 of the stocks that I usually watch will set up. So I've got to place every trade. There's going to be a portion of bullish trades. There's going to be a portion of those that are bearish trades. I'll be profiting in the upswings and the downswings. And that means every Thursday I can be up a mountain hiking.
I like that.
And not worry about what the market's doing or what's going on in the world or paying attention to the Fed. I was at a zoo when the Fed was meeting. You know, it's like, I'm not like watching every tick in the markets because of several pieces that all come together to make it work.
Yeah. It's also what strikes me about this strategy is it's also very cost effective. I mean, you're preserving capital, and it's a very effective way to do that as well.
You're right, it's cost effective. Just by moving over to an option using the full price to premium and always be on the buy side, there's no margin requirements for the stock. You know, so you're not locking up capital in margin requirements for what perceivably could be the same trade. So you get to allocate that other places. You can have the small risk, the small position size, and have all the available capital in your account to have, instead of one trade locked up with, you know, $20,000, $30,000, I can put that to work with 5, 10, 15, 20 other positions if I wanted to. I'm not saying you need to go that crazy, but you should be looking at a portfolio approach. You know, 10, 15 stocks is a nice kind of small account, small portfolio. You could do the same thing with debit spreads instead of singles. So that opens up the opportunity to trade like Tesla, Apple, which is quite an expensive option. You can trade the big name stocks if you choose to, because there's always a way to trade, even with a big account or a small account. So it's very versatile, very flexible in that regard. And again, it just frees up the capital without having to lock it up unnecessarily just because of the vehicle that we choose or that we're forced to choose, because apparently options is a really advanced way of trading. I mean, there's a lot of moving parts, but I wouldn't say it was not necessarily complex, but it's, for a lot of people, it's quite scary when there's a lot of moving parts to consider.
Right. It definitely is something you need to learn, but can be mastered fairly easily, which is a good thing.
It's like anything. I compare it to like learning how to drive or like learning the game of golf. There's a list of rules that tells you, here's the rules of the road if you're driving. Get an instructor. They'll get you to be competent to drive on the road. And then when you've reached competency,
right,
off you go. Here's your license. Off you go. Carry on. You know, and that's what trading is to me. There is a learning curve. I'm never going to blow wind in anyone's sails that it can't be learned, but it's a learned skill. It truly is. And the mistake that I've made and the mistake that I see people make is that they're trying to start their choices with discretion. And they've not got the experience to know what's a good decision or a bad decision. So we can add in the patterns, the Dow theory, the Gann theory, the Elliott wave theory to this process. And like adding salt and pepper to a meal, it's going to enhance the flavor, but you're still going to have the meal if you choose not to do it or you're not experienced enough to do it. For me personally, I don't want to do it anymore. I can do it, but like the sacrifice for me is like I've now got to spend a couple of hours looking at the Elliott wave counts. You know,
Yeah.
It's not critical. It could enhance the flavor of the trade, but I don't need to do it, as I've just shown you with the back testing and the data and all the other good stuff.
Right. And I think you're right. For most people, I'm sure most of the listeners, people are really interested in how do I make money in the market, not how do I become the most expert chart reader that ever lived. They're not the same thing.
How do I make it work? Yeah.
Yeah, that's right.
That's all I want. I want to make it work and make money and not really be super critical about, like, did I count the Elliott wave from here, but it's a different count from there, which, you know, it's not that it doesn't work. It's just the trade-off is you got to spend more time doing it.
No, that's right. You can get lost in the weeds and really miss the whole point of why you're doing any of this to begin with. Hey, I'm conscious of the time here, and I know that you do have some charts you can share with the listeners. Tell the listeners how they can find you and learn more about what you are doing over there at Anti-Vestor and with the programs you have, and how they can find these charts that you talked about today.
Sure. If people like a copy of the charts that we've spoken about or any of the charts that we've not had time to mention because Phil's a little bit of a talker, you can go to my website. Memorable link for you is production line trading. I like to think of what I do as a production line, just like in a factory. So productionlinetrading.com, that'll redirect you to my website. And if you want to contact me there, you can download the list of stocks that I'm talking about that I'm only looking at. And if you like to hit reply on any of those emails, I'm very open and very accessible. If you've got questions about what I'm doing, you know, by all means, get in touch. I try to be as accessible as possible because when I started that, I had no one to ask. So I just like to try and give back as much as possible wherever I can, whether we're working formally together or not, because at the very least, I like to try and point people off in the right direction for what they're looking for. And maybe what I do is not right for them, and that's cool. I'm fine with that. But maybe they'll be able to ask a smarter, more informed question from the next person who generally can help them on the next leg of their trading journey. So productionlinetrading.com, and that'll take you to my main website.
All right, Phil, really appreciate your generosity with that and with all the info today, and definitely would love to have you back on the show another time.
Awesome. Thank you for having me.
All right, that's a wrap on this week's episode. Thank you so much for listening. Don't forget to subscribe so you don't miss a single episode. You'll find the show on all your favorite podcast apps, Spotify, Stitcher, Google, Apple Podcasts, of course, anywhere else you get your podcasts. And you can always find us on marketbeat.com. And please, if you're enjoying the timely market insights we're bringing you each week and finding them valuable, please give the show a 5-star rating on Apple Podcasts. That will help others find the show so we can bring these investing ideas to an even wider audience.